Mohamed, let's jump on a potential third option. As Steve was talking about these two options, is it the buyers that are doing it? It is the sellers who are paying for it. There's a subsection, a third category that could come up part of this, and maybe it ties back to the fact that the jobs market is so weak. Are the makers of this stuff eating it but making up for it by squeezing as much productivity out of as they can out of their existing job base, not hiring new people, and maybe relying a little on AI to get some of that effectiveness kind of wrung out of things?
And you're absolutely right. There's the exporter, there's the importer, and there's the consumer. And so far, the consumer is carrying the least of the burden. I can tell you what's going on right now in companies is they're going product by product, going through the elasticities, what they think the consumer can absorb in terms of price increase without destroying demand. And they're finding out that they cannot pass through as much of the price increase as they want. And that is particularly true for those who sell to lower income consumers. So what we're getting is this has to be absorbed either by the exporter or the importer. They get hit on the profit margin. The consumer, because the consumer is
we've passed it on to consumers for 5 years now, ever since COVID hit. Remember, Carlos Gutierrez came on and said, look, if prices are going up as a manufacturer, as a company, you better get ahead of it and raise the cost to consumers. Consumers are saying, no more. We can't take it.
Correct. Consumers at the time had checks appearing in the mail.
Yeah.
So they were able to absorb the price shock. They cannot absorb the price shock right now. So what we're learning is that the final impact on the consumer is much less than people expected. This number now, if the Fed is truly data dependent, the question should be, why not 50?
Right. Do you think that's on the table in a big way at this point?
If it's a data dependent Fed, it should be. The employment side is much weaker than they expected, much weaker. And now the latest inflation print is much better than they.
But if you're right, then should equities be moving higher on the back of this news? And is that solely a function of the Fed? And does that even make sense at this point in the ballgame?
The economy is not great.
Right. No, that's why this sort of, what's happening now is the market's doing this sort of bad news is good news situation.
No,
but I'm wondering whether there's going to be bad news is bad news.
So look what's happening. When you look at the risk-on assets, equities, credit spreads, they are near or at record level. If you look at the risk-off assets, gold, record level. If you look at government bonds, they're now finally out of they're now in bull market territory since the lows of 2022. So we have this situation where risk on and risk off are rewarding investors. Okay, so don't just focus on the risk on. Also ask the question, why is the risk off also doing so well?
Right, but then square this. We just had Charlie Scharf on from Wells Fargo, and he says that in what he's seeing, and we've heard this from folks at Bank of America, other folks who say, from what they're seeing in their business, everything is just fine. I mean, meantime, then you have Jamie Dimon suggesting maybe that the economy is weakening. I mean, this is why there's a debate.
So he went on to say, and I wrote it down, when you asked him about the lower income consumers living at the edge, there was his phrase. They're running down whatever cash balances they have. The debt data shows it's going up. So it really matters which consumer you're talking about. And I think that's something you've been talking about. Meaning
that they may be spending up 0.3% according to Bank of America over the last month. But at some point, that is not going to continue because they don't have the cash cushion. Maybe they're finally spending down this cash cushion that they've also had since checks were going out back in 2022.
Correct.
And 2020 as well, I should say.
And the only debt that's not going up is mortgage debt. If you look at the burden, credit card debt higher, car loan debt higher, delinquencies on both are higher, right? So the liability side is flashing yellow. The cash side has been okay so far, but if he's right, we're getting to a stage where the lower income people, now the big question has always been, does this weakness migrate up? And this is why people worry about things becoming non-linear, that it gets worse slowly, then it gets worse quickly. Certainly on the employment side, we have enough evidence to suggest that we are near that risk.
Which means what? Now that you've laid out that scenario, what do we do with it?
You heard me say the Fed should have cut in July. If I was sitting in the Fed, I would have a serious discussion about a 50 basis point cut right now. They did it last year. So if I was there, I would have significant discussion about 50. I would want to know how much of the weakness in the labor market is on the demand side or on the supply side. But you need that conversation. And then you need to realize that's not sufficient. Yeah. We also need to move forward on the deregulation agenda to make sure that the supply side responds. I am very optimistic as to what's going to happen to productivity in a few years. I really do believe in the AI, positive shock, life sciences, robotics. Those are all productivity enhancers. We just have to get through the next year or two.